Next, we have Cooley, who has been a sponsor of Raise since year one and has a long-standing reputation of helping emerging managers. Here to share their insights on market trends and statistics, as well as fund structuring today, please welcome Eric and Jimmy of Cooley.
We appreciate the opportunity to be here and to support the Raise conference. This really is the best conference out there for emerging managers and LPs. It also really works. We've been involved with Raise since the beginning, and we've had a number of GP clients get introduced to LPs at the Raise conference and actually invest. And we've seen meaningful connections be built among the GPs and the LPs. So hats off to Ben and Joanna and the organizing team. It's a lot of work, and we really appreciate it. It's an invaluable service to the community. My name is Eric Doherty. I'm a partner at Cooley. I've been in the fund formation practice for about 18 years, and I work with new funds and existing funds and management companies and GPs all day, every day. My colleague, Jimmy Matteucci, is a senior associate in our group and does the same type of work for early funds to late funds. And so we bring a great depth of experience to the fund formation practice and our clients. A little bit about sort of Cooley and kind of what we're seeing in 2021. We have about 40 lawyers in our fund formation group. Cooley formed the first venture capital fund on the West Coast in 1958, and we've been a market leader in GP side representation since then. It's been a robust year for fundraising, as you could expect. In 2021 to date, unaudited numbers, of course, we've had about 230 funds hold closings. They've raised over $29 billion, and about 140 funds have held first closings just in this year. We're seeing a strong pipeline of projected activity into Q4 and into Q1 of next year. And we're seeing a lot of new fund managers as well as existing fund managers continuing to raise funds and come back to market with new and interesting products. We're seeing SPV activity. We're seeing a lot of fund managers talk about opportunity funds and how to take their pro rata. We've had existing fund managers moving into different types of funds. So it's been an interesting time. So we thought we'd spend our time today talking a little bit about some of the questions and some of the things that we're seeing from emerging managers and some evolution we're seeing on market terms. So Jimmy, rolling funds seem to be the talk of the day and perhaps the latest innovation in fund structuring. What are you seeing? Are you seeing them? What's a great use case for them? And let's discuss some of the pros and cons of that kind of fund structure.
Sure. Thanks, Eric, and hi, everyone. So rolling funds are absolutely something we're getting a ton of inbound inquiries about. And I think the best place to start is what exactly is a rolling fund. The idea behind a rolling fund is that unlike a single investment SPV or a commingled blind pool typical venture fund, a rolling fund actually has a new fund every quarter. And every quarter, there's actually a new K1. It's a new partnership for tax purposes, and the commitments are only made for that quarter. Typically, it's structured over time, so you might have an LP that in total wants to commit $100,000, and maybe they do so in 4 quarterly installments of $25,000. And typically, the unused capital from the prior quarter will automatically roll forward to the next quarter unless elected otherwise by the LP. One of the big differences of a rolling fund versus a commingled fund is that when the new investors come in a subsequent quarter, they're not dilutive to the prior investors and the prior investments. So you only get to participate in that quarter's investments. And that's a big difference, again, from a commingled fund. We absolutely think a rolling fund has its place in the ecosystem. Seems to us it's kind of a gap measure between sponsors that maybe are just getting started and raising single asset SPVs to those who actually go out and raise a commingled blind pool fund. It kind of allows an investor to blindly commit some amount of money for some fixed period of time, but maybe not make the full 10-year commitment to a VC fund with a large dollar amount. For the sponsor, it helps build a track record, which is definitely advantageous when you actually go out to raise a full commingled blind pool fund. And it avoids the pitfall of having to fundraise on a deal-by-deal basis if you're just out there in the marketplace right now raising SPVs. It also has the potential benefit of providing, deal-by-deal carry in those quarterly segments, which can allow the sponsors and maybe their growing team to realize carry earlier in the process than if it were in true fund structure. And then finally, for regulatory reasons, there's actually incentives to raising a rolling fund, such as it can be more inclusive because the dollar amounts tend to be smaller and they're in these quarterly chunks. You can open it up to, of course, accredited investors, but investors who are willing to put up maybe $5,000, $10,000 checks Oftentimes, if you have less than 10 million total, you can rely on a investment company act exemption that allows you to have up to 250 investors. So it's a lot bigger than some of the other small funds you see out there. And a lot of the rolling funds we've seen in the marketplace rely on a special exemption under 506C for their marketing, such that they can actually publicly disclose it. So it kind of democratizes the fundraising process. And as a result, we definitely think it has its place in the ecosystem. But Eric, maybe you can speak a bit about some of the downsides we're seeing with the rolling fund structure.
Yeah, and there's some downsides slash complexities. One is that it seems unlikely to work off platform. So you really needs to rely on the automation and the infrastructure that you might have on an angel list or a Carta or really an automated system that can do the accounting, can do the reporting, can bring in the LPs to have. So we're not seeing sort of Cooley sponsored funds, if you will, or clients that we work with raising them. The complexities of having that many investors each quarter, forming new entities each quarter, perhaps separate bank accounts each quarter, the tax work involved really makes it hard to do it sort of offline. The separate pools of capital can also make it hard to have a portfolio theory. So fund managers that are thinking about a percentage of the fund that would be an early stage and late stage, the amount of capital you reserve for follow-ons kind of goes out the door. Follow-on capital, the investors that are in the first investment may not be in the same fund that makes the follow-on investment. It can be tough to sell to institutional investors because the gains and the losses don't offset each other per quarter. You might have a little look back and where it's like a per quarter look back if you're in both, into particular quarters. But the idea that your quarter one would be netted against quarter five, for example, isn't within the model of how these funds would work. If the institutions needed audited financial statements, that would also put a lot of pressure on the cost structure for this type of fund, as you'd be doing 4 different audits every year for the different pools. There's also no way to sell your promise of your existing investments to later stage or later closing investors. We often encourage a lot of new clients to get started, start investing in companies. It gives you something to talk about. You can go back to your investors a handful of months later, talk about the 4 or 5 companies you've made. To the extent that an investor comes in and closes, they're going to own a piece of that investment. Talking to them later is just a part of your track record. They're not going to own any share of the earlier investment. It can also be hard to, and you need to think about how you might pivot out of a rolling fund. I've had a client that started with a rolling fund for a lot of the benefits Jimmy had mentioned, but started to get a lot of traction from institutional investors that wanted to write bigger checks and had some problems with the model. And it was hard to think about how the two would coexist, as you might have had 5, 6 quarters of commitments that you had promised to investors. Are the 2 funds going to co-invest for a while? How are you thinking about the pro rata ratio between the 2 funds? There are some complexities there. Another interesting innovation we're seeing is existing funds competing in part with these types of models and these types of platforms, that it's easier for angels to do their own funds and to get deal by deal carry. So Jimmy, what are we seeing with Scout funds? How are they being structured? And what are some of the benefits and complexities with a Scout fund model?
Sure. Thanks, Eric. Another hot topic to be sure. The goal in a Scout fund model is to pay the Scout deal by deal carry to incentivize them to come work for you, the fund sponsor, rather than, as you noted, Eric, raising their own SPV for the deals that they're sourcing. The structural problem in your typical venture capital fund is that the fund's GP is not paid on a deal-by-deal basis. Oftentimes, you have to return contributed capital before the GP starts sharing and carry distributions. So, as an example, if you had a $50 million fund and a $1 million investment that a Scout brought in that was a 10x return, you might not have actually returned all 50 million of contributed capital, and the Scout doesn't actually get to participate in that carry yet. It creates a timing issue. It also creates some dilution complexity. And so we do see it from time to time, especially if sponsors only have a handful of Scouts and they're giving out small carry percentages, that they admit the Scout to the actual GP entity, and they put some constraints around that admission. It just tends to be less attractive than what the Scout could do on their own if they were to go raise their own SPV. So the advent we've seen is really the Scout fund concept. And it's not often something that's pre-baked into partnership agreements. So if sponsors are interested in this, we either try to put it into new fund agreements as they're going to market, or We have module LPA amendments where we can go out and get LP consent for. But the idea behind it is that we actually form a entity underneath the main fund through which the scout investments will be made. The benefit there is that we can actually grant a profits interest through this subsidiary entity to the scout, such that the scout's getting deal by deal carry before the fund receives any um, income from the investment. Now, this does introduce the concept of double carry, which is why we have to go get LP consent. And oftentimes there are constraints put on the ability to use scout funds. For example, LPs might say, that's great, we like the concept, it's going to drive deal flow, but you can't put more than X% of committed capital through the scout fund to limit the amount of double carry from the fund's committed capital. Oftentimes, another limitation we put on it is that the scouts only get paid on the initial investment. Usually the follow-on investments aren't subject to the double carry. It is something that LPs just need to get comfortable with, but we have found that scout fund subsidiary structure is certainly a way to be reactive to the marketplace where these scouts have deal flow and want deal by deal carry, and be able to offer that to them. Eric, as we're wrapping up here, as far as LPA terms, is there anything in the marketplace you're seeing recently?
Yeah. So, just a few sort of observations of things that are changing over time. One is I'm seeing more premium carry funds and first time funds. And I would have said back in the day, first fund, shoot down the middle of the fairway, kind of 2 and 20, 2.5 to start, but trim down to the fees. But 20% carry is still the norm. I'm seeing a lot more funds that are coming to market with a premium carry, whether it's a straight 25% or more commonly it's a hurdle rate. So maybe 20% with a 3x return, you get to 25. Maybe a 5x return, you get to 30. There's some debate about the GP catch-ups and sort of how that would work into the hurdles and the rates. But there seems to be more at play with respect to the carry. It's still a complicated topic, still something to think about strategically. A lot of it depends on the track record that one has and the types of investments in the network one has. But it's no longer necessarily a straight 80-20 deal for new funds. I'm also seeing pressure, increasing pressure from, from LPs on management fees and GPs being somewhat more responsive to it. So seeing some deals with lower fees or more aggressive step downs. I'm seeing LPs perhaps paying more attention to the J curve. I'm seeing perhaps GPs asking for more carry in exchange for lower fee. We're seeing funds get raised where, a single manager that may have enough individual net worth that they don't need the big fee, and they're relying on the third-party service providers, the back office accounting firms and the like, to do a lot of that work, which is a fund expense. And they're proactively going out with lower fees. They just think it will create better returns for the fund. That might change over time as the institution grows, but it's no longer a simple 2.5% on all the deals. I'm also seeing more cashless contribution mechanisms in the use of the fee waiver techniques that I perhaps tended to see more in the bigger funds, and early emerging managers tend to be using them for the deferral and the alignment of the returns with the income, rather than having to take the management fee income being taxed on it and then plowing it back into the fund. So it might be a two-step of both the LPs wanting more skin in the game from the GP and maybe more GPs without a lot of personal net worth needing to be able to fund that and using a cashless contribution management fee waiver technique to accomplish that. I'm also seeing some more negotiation or freedom, if you will, for the GPs on their devotion of time. The standard turn of phrase we'd used in the market was substantially all of your business time to the partnership and basically the firm that you're setting up and maybe the SPVs and things that you're doing. But some GPs are pushing harder on that and saying, look, don't handcuff me. I might be doing some more advisory work. I'm going to be doing things in the community that will help my personal brand, if you will, and will lead to more attractive investments for the fund. I may want to start different types of funds. I might have develop a crypto strategy when I had a regular VC, stage microcap strategy. So seeing more activity there. Likewise, I'm seeing LPs giving a little bit more freedom to GPs to personally invest in companies. We're seeing companies raising rounds from only angels, and they don't want the big VC firms or even any VC firms on their cap table. And so managers are sometimes investing their personal dollars in the early rounds to create a foothold for their fund to come in for a larger pro rata later. We're also seeing LPs largely becoming more comfortable with crypto and digital assets investments. They typically don't want them they don't want to be distributed in kind because they have trouble under the custody rules, but they seem to be more comfortable with managers pursuing a strategy around crypto. So those are kind of the high level topics of what we've been seeing. We appreciate your time and thank you so much.
Thank you.